It's our third video on bonds. So last time we were getting ready to talk about pricing dynamics, which is just some concepts about how bond prices change relative to their underlying inputs, things like that. So for starters, we're going to talk about yield to maturity versus price. There's a general relationship with all investments. It's not just bonds, but it's easiest to see with bonds. In fact, bonds are great for studying these pricing dynamics mainly because we know all their cash flows. That's not true of all securities and all investments. With bonds, we know what all their cash flows are going to be, so we can do some sort of quantitative mathematical fudging and playing around with the numbers and seeing what happens to different variables, and it gives us a good sort of case study, which then usually applies to all other securities. For example, yield to maturity and price are inversely related, meaning when the required return goes up on a bond, its price goes down. When the required return goes down, its price goes up. Let's do an example real quick to show that. So recall that the price of a $1,000 10-year discount bond with 12% required return is $321. We just wrote it as $322. We did that problem earlier as an example. It says here what happens if the price of the required return rises to 13%. So if I go over to my time value of money diagram here, I've plugged in everything we had before, which is 10 years, $1,000 par. It's a discount bond just for simplicity. This holds whether you're using discount bonds or coupon bonds. It doesn't make any difference. And then we had a 12% interest rate. So you plug all that in, you get 332. So the question asks, what if we raise this to 13%? So bonds trade every day in the marketplace. Sometimes prices go up, sometimes they go down. The result is some sort of yield to maturity. Here we're looking at it as what if the yield to maturity gets pushed up for various reasons. So we talked about interest rates last chapter. Could be that inflation expectations went up. Could be risk went up. There's all kinds of different kinds of risk went up, pushed interest rates up. Could be productivity rose, which would be actually a good thing. But interest rates got pushed up from 12% to 13%. What happens to the price? If I plug all this into my calculator, I get a new price of $295. Oops. So it used to be $322, now it's $295. That's about a 9% drop in the price. So as the yield went up, the price dropped about 9%. That's the general relationship. If I were to lower the rate from 12 to 11, the price would have gone up. The reason is that the payouts are fixed. So if you pay less for them, you're getting a higher return. If you pay more for them, you're getting a smaller return. So as the price goes up, the return you're going to get on those fixed payouts is smaller. As you pay less for them, you're getting a higher return for them. Obviously, you'd rather pay lower and sell higher. If you're going to buy a security from someone else and you are arguing on the price, you would try to argue them down so you buy it cheaper. The cheaper you buy it, the higher return you're going to get on that investment. Okay, so prices, yields, inversely related. To show an example of this, I have a little chart over here, and we're going to kind of expand on this in a second. But this chart, just to show a kind of a basic illustration, this is B-rated bonds by Moody's in the U.S. corporate market. Go back to 1919, so it's a lot of data. It's almost 100 years of data. This is the interest rate that was prevailing interest rate on investment grade bonds. So this is BAA bonds. So this is the lowest rating you can be and still be in investment grade, which means certain companies like insurance companies are allowed to own only investment grade bonds. So you can see that the interest rate's gone down and gone up and gone down and gone up. All these little movements up and down mean something, and if we were having a finance history class, we could talk about all of them. Like this was the Great Depression, this was the 70s when inflation was out of control, this is the most recent financial crisis, things like that. But we won't get into the details of that right now. We don't have time. But let's just look. This is what interest rates. Now let's look at what your return would have been if you were buying a portfolio of these investment grade bonds and just rolling it over each month. So you bought long-term corporate bonds one month, and then the next month you rolled over into long. So you never let them mature. You constantly held long-term corporate bonds. If you were to do that, your returns would actually look like this, which is the blue line. I've put this same line up here in the background as gray. and that refers to this scale. So this is the interest rate. And then on the right scale, and this is a logarithmic scale because things actually grow exponentially, we talked about earlier, and which would make this very hard to read. But I put this in as a logarithmic scale so it should just grow a straight line. So you can see the actual returns you would have earned on a portfolio of long-term corporate bonds is kind of inversely related to the interest rate. When the interest rate skyrockets like it did in the Great Depression, your portfolio tanks, goes the opposite direction. Same thing in the 70s when inflation got out of control and interest rates went really high. Your portfolio of bonds would have got really low. Since the early 80s, interest rates have done nothing but drop except for little time periods every once in a while. And so what have happened to your portfolio? Well, it's done nothing but gone up. I kind of put a reference in here in this straight line. This is just how much you'd have earned if you were earning the interest rate without what we call capital gains, the price appreciation going up. So this is a line that just earns the prevailing interest rate. That kind of gives you a long run average, but then you can see as interest rates skyrocket, we go below the average. As interest rates go down, we go above the average, and vice versa. So that just gives you a quick idea of the relationship between prices and interest rates. So when you buy a bond, just because it says it has a 12% return doesn't necessarily mean you're going to make 12% on it. It's called yield to maturity, which means it's 12% yield to maturity, which means if you hold it all the way to maturity, you earn 12%. Not necessarily. We're going to talk about some different types of risks here in a second, but basically you earn 12%. But most people don't hold bonds for the whole maturity. At some point you might have to sell the bond, just like you'd have to sell a stock before stock matures. Stock never matures. But if you have to sell it early, you could make any return on it. You could make a loss on it that is negative, even though you never have a negative coupon rate, or you could make much more than the coupon rate, depending on if interest rates go up or down. Okay. In order to understand our next pricing dynamic topic, I want to show you a different chart here. This is the same setup. Actually, it's not. Let me change the numbers a little bit. Let's make the coupon rate 10% and the yield to maturity 12. What I have here is I've got sort of inputs of par value, coupon rate, yield to maturity. I've matched these to 1,000, 10%, 12%. I'm doing this with zero coupon bond, or no, actually I'm not. I'm sorry. Disregard that. What I'm doing here is showing you the present value or the price for different maturities. So everywhere from a 10-year maturity down to just a 1-year maturity, what the price of that bond would be. The further out you get, obviously the lower the price gets, because you need to make more money to account for the same return over. You don't just want to make 12% 1 year, you want to make 12% 2 years, 3 years, or 4. And so you have to multiply up so the price gets lower. The concept I want to show you here is what happens when this yield maturity goes up. Let's say I raise it to 13. All the prices fall. Yield goes up, prices fall. What if I raise it to 14? Again, all the prices fall. What if I raise it to 15? Again, all the prices fall. What if I jump up a little bit and raise it to 20? Again, the prices jump a bunch. Let's go all the way to 30. The concept we're looking, first off, we already know yields go up, prices go down. The next concept we're looking at is there's a different relation between how short-term bonds move and long-term bonds move. This short-term bond was about right here when we started. We can go back and look at it. If I move this back to 12, it was up here about $990, it looks like. When I move this to 30, it jumps down to about $800. What happened to the 10-year bond? When it started at 12, it was about $890. When I moved it to 30, it fell all the way to about $390. Meaning long-term bonds are more sensitive to interest rates than short-term bonds. That's called interest rate risk. Another way to look at this is this chart right here. I have two lines on here. The red line, first off let me explain it. Both these are bonds that mature right here at year 0. I've given a date down here on the bottom, which is time relative to maturity. So this is 10 years prior to maturity, 9 years, and we grow up until we get to year 0, and that's when they mature. And then you go 1 year in the future, 2 years in the future, 3 years in the future. The blue line, the difference between the red and the blue line is these are actually both zero coupon bonds for simplicity. They both mature for $1,000, and this is a logarithmic scale. This is actually the logarithm of $1,000, which they both equal on date 0, which they have to, because let's say it's the day before they mature. You're buying a $1,000 payment tomorrow. They're both pretty much going to equal $1,000. So they both converge to $1,000 par value, which is their price, on the maturity date. But as we go out, prior and prior years, so we go further and further before it's time, so longer maturity, they get further and further apart because one's got a slope of 5%, one's got a slope of 10%. The red line is a 5%. That would be the price of your zero coupon bond if you required 5%. Blue's the price if you required 10%. Note that if we're only 1 year to expiration, we're right here. What's the difference between the red line and the blue line? It's very small. But as you get farther and farther out, you get a bigger difference. This is just to illustrate that a given change in interest rates results in a much bigger swing in the price of the security the longer the maturity is. There's actually a concept called duration, which we won't cover in this class, but it directly measures this, which is when interest rates change, how big does the price swing? Well, the longer duration and maturity are very closely linked. So the longer the maturity, the bigger price swings you're going to get for a given change in interest rates. It's called interest rate risk. You have to consider, if I want to invest long term, I'm taking more risk because I'm going to have much more volatile prices of my securities. When we get into stocks, they're going to get even more volatile because stocks are built so that they essentially have a maturity or a duration that's very long, on the order of 30, 40 years. And so they're going to have huge swings for a given change in interest rates. So every time you take a security, you need to know what kind of risk am I taking, and this is one way to measure that risk. The flip side of interest rate risk or duration risk is reinvestment risk. Reinvestment risk says, let's say I get this $1,000 payment on the maturity date. I got to reinvest that money at the prevailing interest rates in the market. Or if you're at the blue line, you get to reinvest at a 10% interest rate, which means your line's going to keep growing at a 10%. If you're at the red line, you have to reinvest at a 5% interest rate. It's going to grow slower. So while the present value for a higher interest rate security is actually lower for higher interest rates, meaning interest rates go up, prices go down, the future values are the flip-flop. If you want to have a higher future value, as long as it's farther out than your maturity date or your duration date, you actually get higher if you pick a higher interest rate. So there's a trade-off there. Do I want to take less risk today but get less return in the future? So interest rates going up is bad today, but it's actually good in the future. It means you'll have a higher future value if you wait long enough. So if I flip back to my notes here, whoops, that was the wrong page here. The next thing is interest rate reinvestment rate risk. I'm not going to say any more about that. That was just kind of to cover the concepts. The next thing we'll talk about here is current yield versus capital gains, and we'll finish the lecture up there. So we don't have a lot of time, but real quickly, you can take the return on any security and you can break it down into two components. One's we call current yield and one we call capital gains. Current yield is like income you receive. So it's obvious on a bond what it is. It's your coupon payments. You receive some payment. If you divide it by the price that you paid for it, that gives you an interest rate, which is per dollar I paid in, what check am I going to get in the mail? What income am I going to get as a percent? The other way you can make money is in terms of capital gains, which is the price of your bond can go up and down. And that's true not just of bonds, that's true of stock. In terms of dividend yields, that's true if you buy real estate, you might get rent checks, that would be your current yield, that's your income, but the price of the real estate might go up and down. So we can break up into those two categories. As example, recall from previous that the price of $1,000 10-year bond with a coupon 10%, yield to maturity is 8. What's the current yield and capital gains? I got to do this real quick, so I've written it out here. Current yield is your $100. You'll have to go through and read that on your own because I didn't have a chance to read it. But you'll get a $100 coupon payment divided by the price. That's at 11.3% current yield. You know you're making 12% because that's yield to maturity, so you get a 0.7% yield to capital gains. So that means you can figure out how much you expect the price to change. All right, we're about out of time here, so I got to wrap it up. We've covered the basic definitions of bonds, we covered how to price bonds, and we covered a couple little pricing dynamics which you might receive some questions on.